I hope that you and your loved ones are keeping well and safe. Um, it's been a different year. My name is Ladi Runsewe. I am the founder of Your Family Office. It's a multi-family office born out of the need to represent and connect African entrepreneurs and their families with the right fit of professionals, enablers, and established contacts to take them through all circumstances that they need in the UK. I want to thank you all very much for joining today. This topic is property, tax, and estate planning for Nigerian global citizens. Actually, this evening, I'll take it even wider to African global citizens because we have representations across Africa on this call tonight. These are Africans who have connections into London, but also in some cases into Nigeria. And I want to thank you so much for joining today. When I was looking at this presentation and the webinar, what was important to me was not just getting professionals who were good at this topic, but also professionals whom I know have worked with Africans and they get it. Important to me, professionals also have the best interest of Africans at heart. I'll start with Simon Goldring, who's a partner at McDermott Will Emery. It's a full service firm. Simon is well known and respected in the Middle East, but also in Europe, and he's delivered for African clients. Simon is bold. I say this because he once told me about a story where he was on a meeting with a prospect, a key prospect. And at that meeting, he had told the prospect to please kindly turn off his mobile phone because the prospect kept using his phone throughout the whole meeting. The reply of the prospect was, actually, no, I'm not, I pay your bills. Simon's reply back was, no, you don't, this meeting is free. That was bold of Simon. I'll let you guess what happened next. Good evening, Simon.
Good evening, Ladi, and firstly, thank you very much for inviting me to participate in this amazing seminar. For those who can't guess the answer, the effect was that the client or potential client never instructed me and I never heard from him again. On that note, I'll pass back to you.
Thank you very much, Simon. The next speaker is John Walters, a director of Robert Bailey Properties, a residential property buying agent in prime central London. John is a good friend, but also a contact phone I need to have on my phone because he's that kind of person who knows someone who knows someone who knows someone. John was born in Dubai and was raised in Southeast Asia. This has given him a good understanding of international business and a truly global client base. Hello, John, how are you today?
Hi, Ladi. I'm very well, thank you. And thank you very much for inviting me to participate this evening. Hope all is well.
Good. Thank you very much. Next is Esiri Agbeyi, a partner at PwC in Nigeria. She also heads the family office offering at PwC. Esiri is a well-respected professional in Nigeria, and she's a well of information. I say this because on all my trips to Nigeria, I spend at least 30 minutes with Esiri, where we just talk about all the macro and micro factors in the economy. Esiri uses 3 people to describe herself: Picasso, Beyonce, and the Michael Jackson you've never seen on stage. Energies for days to draw art, sing, and dance, but tonight, she's channeling all those energies to tax and business. Good evening, Esiri.
Good evening, Ladi, and thanks for having me. And I've got my colors on. I need to represent my country. Energy for days, country right. Thank you.
Magic, magic. Lastly is Stuart Wakeling, who's a director at Henley Partners. He's a good friend. He's always delivered for African clients, for my African clients. And in fact, his team helped set up this whole technicalities of today. And I really want to thank Stuart and Elena for this. Stuart spent his childhood growing up on a farm in the middle of the deepest, darkest Somerset in the countryside of Southwest England. He lived 2 miles from his nearest neighbor, 6 miles from his nearest shop, and 14 miles from his school. Living in such isolation taught him the importance of human interaction, and it's something that he really, really cherishes and uses now to the best of his ability in his current role. So for those of you who know Stuart is always chasing for his paperwork, it's not just about business, he also needs that interaction. Hello, Stuart.
Good evening, Ladi. Thank you very much for having me. And thank you to all our attendees. We really appreciate it.
Good. Thank you, Stuart. So the webinar should last an hour. Please paste your questions on the question tab just as we walk through. We have plenty of time to take questions at the end. Now, delving into the theme of today, which is on property, tax, and estate planning for African global citizens. Stuart, you'd have heard the horror stories at the start of the lockdown in March of African families being separated from one another because of either they had to renew their visas or their travel documents were stuck in some immigration office of the sort. On the other hand, there were African families who had easy access to global mobility. And as soon as it was announced, they pulled their families together in one location and literally they were to work together, bond together. Kids continue to do their homeschooling through distance learning. Life sort of carried on basically, and they enjoyed that time together. Stuart, can you share how Henley Partners have been able to help African families with easy access to global mobility?
Absolutely, Ladi, and thank you. So if I start with just explaining a little bit more about what we do at Henley Partners. So we are the global leaders in residence and citizenship planning, and we have been for more than 22 years. What does that mean? Well, in very simple terms, it means that we are the people to come to when you want to obtain an alternative or additional citizenship or residence, as so many African clients do at present. We have over 20 programs ranging from Canada to EU citizenship, EU residence, the Caribbean, Australia, and of course, the main topic of our conversation, the UK. All of these programs available to people from Africa who want to obtain another passport or residence via investment, earning themselves visa-free travel to up to 183 countries, thus, in essence, giving them far greater global mobility. Annual new client numbers in Nigeria alone have increased by over 400% since 2016. It's important, I feel, to point out that I've never had a Nigerian client who isn't proud to be Nigerian, and rightly so. Often in the past, we were faced with clients saying to us that they don't want to be any less Nigerian and they don't want to necessarily leave Nigeria. People are now realizing that what we offer doesn't conflict with these beliefs, and getting another passport doesn't make them any less Nigerian. It gives them plan B alternatives. It gives them visa-free travel. It gives them added security and the ability to be with their family and friends in times like we're just discussing. It gives them better business opportunities, the list goes on. We do have 30 other offices globally, including South Africa, Dubai, then the UK, which is where I'm based when I'm not in Lagos. We offer free, impartial advice and handhold our clients throughout the entire process until they achieve their chosen result.
Very much for that, Stuart. So now 2 questions here. What are Nigerians, or in fact the wider Africans, doing at the moment and why?
Yeah, good question. So currently, whilst we always see a steady stream of interest in the UK, the US, Canada residence programs, over the last 2 or 3 years, there's been a large increase in applicants for the Caribbean citizenship programs, Antigua, St. Kitts, Grenada, St. Lucia, etc. Investment migration is no longer available just to the uber rich, which is key. The Caribbean programs are in fact the cheapest route to an additional passport. They're also quick to process. They give clients access to, on average, 150 countries visa-free. And I think that is a really important point. I hear so many people from Nigeria telling me the horror stories they've had with obtaining visas or passports going missing, etc. You have this passport, you travel 150 countries visa-free.
Thank you very much for that, Stuart. So while all your clients are doing this, what is the #1 destination for families? What countries they want access to and why?
Sure. So obviously we have a number of historic clients and new clients enrolled on the UK or the US residence programs as they want direct access to live in those countries. In terms of access, however, the clients that are choosing the Caribbean's or the European citizenships as their program of choice, every single one of those people has checked with me to ensure that what they're obtaining gets them visa-free access to the UK. The UK stands out as the most popular destination by quite some way. Almost all of the citizenship programs we offer to investors allow successful applicants to travel to and spend significant time in the UK without the need for ever obtaining another visa to the UK, for many reasons. Obviously, the initial desire to live in the UK is the standout, but then there are subcategories as to why they have that desire. They may want their children educated in the UK. They may want to have UK real estate, or they may already have UK real estate. They may want access to the healthcare systems, the general stability of the UK when compared to their home countries, etc. It may be for business reasons, health reasons, the list is endless. As mentioned, we at Henley Partners have many, many different programs available and something to cater for most criteria and budgets. We're always happy to offer free, impartial advice to anybody who is interested in what we do.
Thank you very much, Stuart. Now, John, coming to you, for these families who want the global mobility and choose the UK as their home away, but also for investments, can you share with the audience what your house view of the asset class in the UK in the last 10 years has been today?
Yeah, I think, I suppose before I just answer that question, just very quickly, in light of the new lockdown in the UK, I think it's important for people to understand that the UK property market remains open. There are still some restrictions, but transactions can go ahead, viewings can go ahead. We're still out with clients and transacting, and the market is quite busy at the moment. I think, yeah, going to your question of London over the last 10 years, it's a story of evolution, really. Going back a decade ago, when people came to us to search for a home, you'd be looking Chelsea, Kensington, Knightsbridge, the old golden postcodes, and through a variety of infrastructure projects, the areas people are looking at are changing a bit. Marylebone, for example, has come on leaps and bounds. Notting Hill, although it was popular 10 years ago, is probably far more popular now. Areas like Bayswater are seeing significant investment. So what we try and do is try and guide our clients not only to where they might find a suitable home for now, but also for the next 5-10 years, getting the inside track on what is happening in the London market. So it's been fascinating to see over the last few years.
Thank you for that, John. And John, are families still interested in London, or are they looking more into buying in the country?
I think there is always a bit of ebb and flow between London and the country. I think with lockdown, the beginning of it, there was a lot of news stories about people moving out, people going to the countryside. There are some people doing that, but I think the reality is that most people, certainly that we're talking to, who've been isolating in the countryside, they miss London. They want to be where the heart is, where things are pumping, where things are going to happen. And even when we're in lockdown, just a simple walk down the street to say hi to your neighbours was a real blessing. Whereas if you're stuck in the countryside, it's incredibly difficult to do. And there is always a natural flow for people, particularly young families who need a bit more space to go out. But we're seeing a lot of people coming back into London, and the sort of inquiries for people moving lock stock out of London. It's not as prevalent as perhaps the press are saying. The London market's phenomenally busy at the moment.
John, what are the considerations for buying a property before and after?
I think what we do with our clients and where our expertise really comes in is we help them to really understand what it is they're looking for in a residential property. Is it primarily an investment, or is it primarily a home? Because they're two very, very different searches. If we probably concentrate more on the home search, it's very important to understand people's lifestyle. Where do they like to eat? Where are the kids going to go be at school? Do they need to fly in and out of Heathrow or Gatwick or somewhere else? you know, where is their center of the universe? And if they don't know London, we spend a lot of time guiding our clients around and showing them different neighborhoods. And, you know, what we do is incredibly personal. So we get to know people very, very quickly, and we can say to them, look, okay, we've met you. I know you said you really want to live in Chelsea, but actually come and have a look at Notting Hill. You might find it a bit more fun. You might find it a bit different. And we help people to explore those different options. On an investment search, it's incredibly important to be close to transport, to have low outgoings. Some of the residential flats in London have pretty heavy service charges, particularly in new builds. You've got pools, gyms, and things like this. You can be paying £25,000–50,000 a year just in service charges. So I think, you know, people need to be very careful about how they approach a property purchase. It's vital to be really, really well prepared. You know, myself and my colleagues at Robert Bailey Property, we can advise on the value of a property, how it's likely to perform over the next few years. But it's really important at the beginning to have your structures in place. And obviously there are colleagues on this call who are far better placed to advise on tax structures and what entity you put a property in, whether it's a company or your individual name. And it all will depend very much on your individual circumstances.
Thank you for that, John. So from what I hear from you, it's very important to get that tax advice, that legal advice on when you're buying property in the UK, especially when the wealth is coming out of the UK into the UK, correct?
Absolutely. Ultimately, you know, when you're buying a fairly significant asset in the UK, which I think most people on this call will be looking at something relatively significant, it's very important that you have a holistic view on your tax affairs, your financial setup. You know, we've all heard of stories of people buying things in the wrong structure, or they haven't thought about certain inheritance tax liabilities and other ongoing costs, which we'll go into later. You know, I can, as I say, myself, my colleagues, we can advise on the value of the property, make sure that they're buying something sensible and that will perform well as an asset beyond that. But you need a really good lawyer, really good tax advice, and the earlier you get that, the better.
Good. Thank you very much for that, John. Esri,
Pleasure.
coming to you. Why is it now important, particularly in Nigeria, to take tax and legal advice when buying real estate in the UK, setting up business structures out of Nigeria, and taking up dual residency?
All right, thanks, Ladi, for the question. And I'll take that from two perspectives. You know, one on, you know, the tax incidents for the individual and the tax incident for any corporate vehicle that's used to make that acquisition of property, as John had mentioned or alluded to. One of the things we see, and in fact, just using the example from what happened during COVID, was individuals were either stranded in their home country or they were stranded in visiting or host countries that they were visiting in. And there were a lot of tax incidences coming from there. Once you get another passport, that's always going to be something to consider. One is you now have access to a whole lot of countries. You can travel anywhere, you can stay anywhere you want. You can buy property in some of those jurisdictions that are now visa-free. Once you begin to do that, you increase your footprint, and that footprint or global footprint has tax consequences. I don't like to bust people's bubble. Tax shouldn't be a difficult subject, but it's definitely a subject worth considering. And so when we had people who were stranded, say in Nigeria, or stranded in South Africa because they couldn't travel back into Nigeria, or the UK, for instance, there were questions around how many days am I spending in those jurisdictions? A lot of tax authorities are beginning to look into areas that could bring in more tax revenues. Why? For a number of African countries, we do have budget deficits. And to fund those deficits, you know, some of the areas that they're now looking to is tax. These are countries that are tax rich, commodity rich. Nigeria is one country that drives or gets most of its revenues from crude. And we've all seen the slump in crude oil price. Now, the next big source of revenue for any country would be taxes. And so the opportunity to then begin to raise those taxes because you've increased your footprint in those jurisdictions is something to watch out for. In the UK, and I'm sure Simon will speak to that, you're looking around things like, you know, whether or not you're creating a residency because of the day count there, or you have ties to the UK, perhaps through the acquisition of that property. And once you begin to have that, you then start asking questions around whether or not you're taxed in multiple jurisdictions and how you manage that. It's always warming when you have countries where there are double tax treaties in place so that you can mitigate any double taxes that arise. Or where you don't have double tax treaties in place, then double taxation becomes an issue. So you get taxed, for instance, in Nigeria at 20%, and in the UK, you get taxed at, say, 40%. But then again, good enough, we have a treaty with the UK. Assuming there was no treaty, or now that we know that there's a treaty with the UK, the other consideration is where would be the country that you pay the taxes to. All those ties you create, the day count, are then factors that are used to consider which country has the superior taxing rights and which country you pay those taxes to. So for instance, we then settle that UK is the country to pay the tax to because you've spent so much days, you have strong ties there. What's the tax rate you're paying? That reduces the value of your assets or the value of your income. I'm proudly Nigerian, I'm wearing the Nigerian color, but if I were going to advise you, you probably want to pick the country with the lower tax rate. And Nigeria has a low tax rate at 19%. But the other reason why this is also very important is we're seeing a lot of collaboration amongst countries. And that's also sprung out from questions around illicit flow of funds. You're transferring funds, for instance, to offshore financial centers, tax havens, and some countries are feeling, oh, we're not getting the right or the better part of the stake. How can we ensure we get those? And for them, we've all settled that the right way to get it is access to information. So there are a lot of transparency regimes now coming on board, voluntary disclosure regimes coming on board to enhance the sharing of information across countries. Only very recently, Nigeria implemented something we call the Common Reporting Standard that would allow financial institutions to supply information on you as an account holder to a jurisdiction that has signed the CRS agreement with Nigeria. And right now, we have about over 100 countries that have signed the CRS agreement, Nigeria being one of them. So this means if you open an account in the UK, or you open an account in Antigua, if they've signed up for CRS as well, any information or funds that you put in there in those accounts or assets you buy, that information is passed down to Nigeria. What's the next big thing that the tax authorities would then be looking to do with that information? It's really, what's the source of those funds? Have you accounted for taxes appropriately? Are we sure you pay the right taxes to Nigeria? Otherwise, we clamp down on those accounts and there are possible penalties on those. And I think the last comment then would be around other developments apart from taxes that are coming up. There's a lot of other non-income tax issues that you need to consider, whether they're indirect taxes or transactional taxes, like stamp duties, where Nigeria now is beginning to raise a lot of awareness on stamp duties. Once you sign a contract, there's a duty that probably arises, and you need to think about that ahead. There's also going to be considerations around not just stamp duties, but you want to think through things like, what do I want to leave for the future generation or the next generation? And that takes us to another separate discussion on inheritance taxes that may possibly be assessed on the next generation. And again, that's another thing that's happening in Nigeria that people need to be aware of. If any of those assets have to pass through probate because you're transferring those assets to children or another family member, there has to be a probate levy, which is almost similar to what you have as inheritance taxes in other jurisdictions. And those can be significant where you have illiquid assets. So those are assets where they're not cash rich. Your buildings, significant luxury assets. If you're paying 10% of the value of those, how do you fund those? Those are things that you need to start thinking of ahead. And now, when you're acquiring that dual citizenship, because all of those would then determine how much value you have left in your portfolio. You don't want to be poorer because you got another citizenship. You want to be richer. And one of the ways to be richer is to make sure that taxes don't steal from you what you should keep in your pocket. All right. Thanks, Ladi.
Thank you very much, Esther. That was great. Thank you very much. Simon, can you share with the audience the other perspective from the UK?
Absolutely, but wow, how do I follow Esri? An amazing presentation, thanks very much. I think the first thing I just want to touch on is following on from a number of points Esri made from a UK perspective. And she talked about two things, one of which is particularly relevant at the moment, which is individuals being trapped in countries because of COVID-19, either because they contracted the virus or they just can't get back to where they need to get to. One of the first things the UK government did back in March of this year, when the virus really hit, was to provide an extension to what's known as the exceptional circumstances test. We have a UK statutory residence test, which, as Esri said, is really determined by reference to the number of days you spend in the UK. Sometimes of relevance is the ties you have to the UK. But a number of clients got stranded in the UK, the effect of which is that they could have gone over the number of days which they were able to spend in the UK without being resident. Now the revenue have relaxed those rules, and they've provided an extension to the exceptional circumstances test. But only last week, and again, it's really confirming what Esri was saying, we've had a little missive through from the revenue or through our sources at the revenue, saying that if anyone makes a claim that they were non-resident, relying on this extension of the exceptional circumstances test, the revenue will be looking into it. You can't just use it as an excuse, and you've really got to be able to demonstrate that you really took all efforts necessary to return to your country of origin. So I wanted to mention that. As we also talked about the UK-Nigerian double tax treaty, and that's a treaty which applies to income tax and capital gains tax. And she talked about the different taxing rights and the relief from double taxation. But what we also have in the treaty is something called a tiebreaker test, because residence is determined under domestic legislation, and it's possible that a Nigerian could be resident domestically both in Nigeria and the UK. So we have this tiebreaker test, which enables a determination of which country the individual is resident. And that could be quite important if people have been stranded and can't take advantage of the exceptional circumstances test. So I just wanted to make those points before really talking about people buying UK property. Because in the past, there were really very few considerations, certainly tax considerations, which were necessary when you were purchasing UK residential property. And people who were non-domiciled and non-resident, that is, so a non-domiciled person is really someone born outside the UK, they could easily avoid any liability to tax in the UK by purchasing the property through a non-resident company. All of those matters started to change back in 2013, when the UK government introduced the annual tax on enveloped dwellings, the company being the envelope. So the tax is commonly now known as ATED, and it's a tax on properties fundamentally used for personal personal use, i.e. not being let out for investment purposes. And there's a banded system. The band now starts at 500,000. And so we have 500,000 to 1 million, 1 million to 2 million, 2 million to 5, 5 to 10, and so on. And depending what band you fall in determines the charge you will have to pay every single year. Now, the bands, sometimes the relevant bands for perhaps people on this call, this webinar, are the bands 2 to 5 million, where the present 8ed charge is £24,800 every year. And for properties in the range 5 million to 10 million, that increases to 57,900 every year. So it's quite a significant charge. There are ways by which this charge can be mitigated, particularly if you're buying for investment purposes. If you have a property lettings business, you can't just let to relations. So it's very, very important that you seek advice at the outset. I think the government thought that this introduction of 8ed would prevent people buying through corporate entities, because the introduction of 8ed wasn't really about getting tax out of people. It was all to do with transparency and anti-money laundering provisions, because they wanted to know who the beneficial owners of these properties were. But the charge, as high as it is, was still less than 1% generally of the value of the properties. So clients weren't encouraged to purchase in a different manner. So what the government has done over a period of years is, first of all, introduced increased rates of stamp duty land tax on purchases of residential properties through corporate entities. It's also, I don't really understand why, because I generally act for people who are non-domiciled, and many of which are non-resident in the UK. The desire of the UK government to bash my clients is astonishing, because they contribute to the UK economy. So what did the government do in its wisdom? In 2015, it brought in further changes by introducing capital gains tax for non-residents who are selling residential property. That still didn't discourage clients from buying. So what do they then do in 2017? Some say it was the final nail in the coffin, although I don't see any change in clients from overseas looking to purchase property in the UK, because I think, as John confirms, the UK has an amazing land registry system, protection of laws and rights of citizens, and notwithstanding things like Brexit, the UK is still one of the main places people want to spend their time. So what were the final changes? It was the introduction of inheritance tax on all residential property structures. So that's whether it's held through a corporate entity, whether it's held through a trust, whether it's held individually. So that's where we presently are in terms of taxes. But all is not lost, as there are a number of practical steps which can be taken to mitigate the taxes. And in deciding what mitigation steps should be taken, and as John alluded to, the first question that you need to ask is, why are you buying this property? Is it for your personal use, or is it for investment purposes? And how long do you intend to own the property? Because if it's not a long-term acquisition, a family home for generations, then some of these taxes which we might be worrying about, actually in practice, don't apply, because by the time the family members, the senior family members have passed, the property's been sold and the proceeds of sale have been removed from the UK. So as I said, the first question to ask is, why are we buying? If it's for personal use or investment purposes, and there are different strategies to avoid or mitigate the tax in both of these circumstances. So at a very basic level, property purchase for personal use can be mitigated through the use of multiple ownership structures. These might help mitigation of stamp duty land tax, inheritance tax, capital gains tax. So traditionally, it might be the case that the patriarch would purchase the property. If pushed, the matriarch might as well. But sometimes if you can bring in other family members, your children, that can help mitigate all of these taxes. Another very simple method, and I'm a great believer in simplicity, notwithstanding the fact I'm a tax lawyer, is put in place a decent UK tax efficient will. Look at how the property is owned if by more than one person. Some of these simple steps can save a lot of tax. If you're buying an investment property, actually company structures can still help mitigate taxes. Whilst there might be an increased liabilities to stamp duty land tax, if you're receiving rental income or you're making a gain on the property, that income and gains, they're now taxed at corporation tax rates, which are presently 19%, as compared to the highest income tax rate of 45% and the capital gains tax rate for residential property of 28%. So corporate structures for investment properties can still be beneficial. And there would be something wrong if I didn't have a way by which every single tax I have mentioned can be avoided. And I do have such a structure. It's not a simple structure. It involves the investment through a structure of funds in property which aren't just limited to the UK. So if you hold a sufficient percentage of your investment properties outside the UK, structures can be put in place with a view to avoiding virtually all of those taxes. So that's probably enough of me for the moment. So I'll hand back to you, Ladi, to carry the flag.
Thank you very much, Simon. That was very well covered. Esria, are there new policies coming down next year that clients and people on this call should be aware of in terms of considerations?
Yes, so in 2019, Nigeria started a process of annually reviewing their tax laws, not only the tax laws, but other business impacting laws. And one of the reasons that's being done at the federal level is to ensure we have the fiscal policy that well aligns with the revenue policy, management policy. So we had a Finance Act that was put in place and that altered a number of things, brought in very welcome changes, including stuff around real estate investment trusts, which we didn't have before, interest in tax benefits as well. And in fact, this year, we've had major changes with a new company law, the Companies and Allied Matters Act, that has also introduced a variety of provisions targeted at ensuring that business is easy and done easily in Nigeria, but also targeted at ensuring that corporate vehicles that are set up, you have a wider range for those, and the ease of setting those up are not overly complicated. For next year, we're also expecting another Finance Act 2020, which hopefully would address some existing gray areas in the tax laws. But one thing that's sure is government definitely is looking to raise revenues. So there's going to be a lot of focus on tax laws that have not been put into use. There's going to be a lot of focus on areas where they feel there are loopholes that have been overly taken advantage of. And so what it means is a lot more scrutiny or focus, if you haven't paid attention to it before, now needs to happen with tax planning. And I think that's becoming, top of agenda on discussions I'm having with family businesses, high net worth individuals, and even companies that are driving a lot of growth in the market. So it's going to be important. And again, just going back to the topic of global citizenship, as you begin to get across into other jurisdictions, the likelihood of setting up companies there also exists. And I'm glad that Simon has pointed out some of the issues to think of from a UK perspective. There are issues to think of as well from a Nigerian perspective, because you then want to look at income that's coming to me from some of these companies that have set up, assuming I did buy property for the purpose of making a capital gain or for the purpose of making rental income, and it's not for residential purpose, not for my personal use. How is that going to effectively be taxed in Nigeria since, you're a Nigerian citizen? Those are tax rules to consider. And those are areas where the government is going to be looking at amending in the future to the extent that we have gaps. We do have gaps to the extent of foreign income, and there are varied interpretations when it comes to taxing of capital gains that you've earned on foreign assets or even rental income you've earned from overseas. One of the other things that we're seeing now is, I'd mentioned it before, transparency and disclosure regimes. We've gotten CRS on board. I was going to also mention the fact that there's a register, for instance, in the UK, where trusts would have to be, information on trusts would have to be submitted. And that's also an area that's going to be of interest with those of you who would be acquiring real estate, either in the UK or even in Nigeria. If you're using any of those vehicles, there are tax consequences that you should be wary of. Now, once you have stuff like that and you're looking at those vehicles or companies that are holding those assets, you want to be sure that there isn't separate levels of tax at any level of acquisition. So at the corporate level, what's the tax rate? Is it just going to be a pass-through so that I don't have to pay tax at the corporate level and then pay tax in as an individual? That gives you different levels of tax that you want to avoid as much as possible. And again, those are areas that very easily the tax authorities will look. They'll be scrutinizing to be sure that they get as much from every layer that comes to their fore. And so those structures need to be tight internationally, taking in mind or bearing in mind current laws, updates to those laws, loopholes that exist, so that you're doing things within the ambit of tax avoidance, but you're also doing it from a moral perspective, because there's a lot of clampdown now on individuals who have access to wealth and are using those tax laws to either shelter funds in tax havens and not paying appropriate taxes. A lot of civil society groups, NGOs, are clamping on them. We heard about the Panama Leaks, the Paradise Leaks, clamping on them and saying, oh, you're not doing this morally. You should pay taxes at least from where you're getting the source of income from. It's the messaging. The messaging is important as well. So whilst you may pay the right taxes, you do want to have structures that protect whatever information is going out to the public. And so public relations also becomes very important. Paying attention to how all this is unfolding across the globe and also in Nigeria will make sure that you're in a safe haven, if you permit me to use that word. The other big thing I thought would be good to also highlight here is we've talked of taxes a lot. We've talked about making sure the structures are compliant. We've talked about the fact that there's going to be a lot of sharing of information. One other scheme that I think is getting a lot of attention now, which is something the government just put in place, is the Voluntary Offshore Assets Regularization Scheme. It's called the VOA scheme. And that's also something where the tax authorities are, or the government, the federal government actually, is working with banks to be sure that if you have accounts in those banks, you fulfilled all obligations that you have to fulfill in your home country. And those obligations also include tax. Some of those policies are things that are unfolding right now. Some people haven't heard about it. Maybe your bank hasn't contacted you yet. But as you venture into all of these jurisdictions, the banks definitely would let you know that this is what is going on. So I think it's just ideal that you stay in touch with updates, developments, policies that government is passing across, and make sure that you're telling the right story and the narrative is consistent, because we have all of this sharing schemes, these voluntary programs. The information you give to this one has to be the same you give to the other one. It can't be different, so very key and vital to bear that in mind.
Magic. Thank you very much for covering that really thoroughly. Thank you. Now, Simon, can you cover on the UK perspective new considerations that our audience need to be aware of, policies that are coming down the line later this year or even next year?
Absolutely, but as you know me, there would be something wrong if I didn't pick up on some of the things Esri was saying. The most important of which is, and it is really important, give the same story to the Nigerian tax authorities, the UK tax authorities, because they talk to each other and you'll come unstuck. Then I highlighted 4 points that she mentioned. First of all, the Panama Papers. And for those that don't know, that was a disclosure relating to Panamanian companies established by a Panamanian law firm. But I was going to say, I'm proud to say that I had 140 clients mentioned in the Panama Papers, none of which had done anything wrong at all. So when we have maybe I shouldn't be proud of that, I don't know. But my clients commonly use structures because we're here to help our clients mitigate their tax liabilities and structure their affairs to protect their assets and for their generations to succeed. So don't be afraid. Some of the other points that Esri made, she mentioned the UK Trust Register, which when it came out a few years ago scared us all to death. But it's not so scary. You have to register at a time that there's a potential UK tax liability. So if you're holding a property for personal use, that's only likely to arise on death. So, but one important thing, and I think it's something that a lot of people could become unstuck on, is something that's proposed next year. We already have a beneficial ownership of companies in the UK, and there's a proposal to introduce a beneficial ownership register for people who hold properties. That's due to come out in, I think, the spring or summer of 2021. I've seen the draft legislation. I'm actually advising on it at the moment, but we've seen nothing to say that it's not coming in. So what's that designed to do? It's designed to look through these structures where we have property owned through corporate structures. I think that could lead on to inquiries where people haven't paid their ATED liability. So just a word of warning there. A lot of clients are looking to restructure because they bought their properties through corporate structure and they're suffering ATED. Now's can be quite a good time to look at those because of low property prices, reduction in SDLT rates, things like that. So it's worthwhile looking at. As we mentioned, tax rates at different layers, and I entirely agree with her there. I think one of the advantages of holding investment properties through a corporate structure is that, first of all, you're able presently to deduct the interest you pay on loans to acquire those properties, whereas for individuals purchasing, that relief is now severely restricted. So you reduce the rate of tax upon which you're going to pay on your income. Secondly, the corporation tax rate is then only at 19%. And finally, there's no withholding tax on dividends to non-residents. So sometimes corporate structures can really help mitigate your tax liabilities. I think the last thing that I wanted to mention, I think I've touched on it, is the voluntary disclosure provisions that Esri mentioned. We had similar provisions which have now expired called the requirement to correct. But what I would do is encourage people not to keep their head in the sand if they feel they have a tax liability that they haven't disclosed. Because believe me, with things like CRS and the cooperations of our respective governments, they will find you. And if they find you, the penalties will be much higher than if you go voluntarily, as much as 200% of the tax, which you would also have to pay along with interest. So those are just my comments on what Esri said. Just a couple of developments. I, of course, already mentioned the extension of the exceptional circumstances test, but a couple of points which I think are really important now for people who are in the process of or looking to buy residential property in the UK. First of all, a few months ago, the government announced a relaxation in the stamp duty land tax rules to stimulate the UK property market. Now the result of that is until the 21st of March 2021, stamp duty land tax does not start until £500,000. So if you're purchasing a property for less than that value, you'll pay no stamp duty land tax. I think I'm never too good on rates, but I think absent this reduction, stamp duty land tax starts at £125,000. So it's a fairly good relaxation. And even if you're purchasing a property for substantially more than 500,000, you can still save tax of £15,000 at the moment. So if you're going to buy, now's a good time to buy, especially because of the second provision, which is coming into force on the 1st of April 2021. Again, I find it astonishing that the government are seeking to penalise non-residents in that if they acquire property after the 1st of April 2021, they're going to impose a surcharge, a further 2%, on the already hideous stamp duty land tax. So maybe the message there is it's a great time to buy because of things like COVID and Brexit and the uncertainties that creates. You can get a good bargain at the moment and pay less tax. I think I've already touched on some of the practical things that should be done. My big message is don't not do anything because you're scared of paying fees. It's actually really important, and it's important that taxes are considered not only from the UK but also from the Nigerian perspective or whatever country you're looking at. it's important to engage professionals like John and Stuart to make sure you're doing the job properly, you're getting the proper services. And above all, it's important to use people like Ladi, who pulls us all together and makes things happen. Maybe I'll just finish off at a very basic level in terms of planning. Take advice. At the simplest level, think about multiple ownership structures, tax efficient wills, maybe the use of companies, maybe the use of trusts for asset protection, succession planning, sometimes Sharia type planning. But you know, these are complicated subjects, and what our objective is to help you navigate those complexities. In finishing, I'd personally like to thank Ladi for pulling this together, and also the help of Henley Partners, which I think we've had an amazing bunch of panelists, perhaps me accepted. Over to you, Ladi.
Thank you very much, Simon. I really appreciate it. Esri, what should families on this call be thinking of when you think of succession planning? Should it be structures, trust, or wills? Simon's covered his bit, so if you just cover from a Nigerian perspective.
Yeah, so I think all of those are very important. When we talk about trust, you know, this is an age-long thing that has always been in place. We took most of our laws from the UK. So we have them now here, although we haven't really made so many amendments. But what used to happen in those days is when the Crusaders go away into battle, then their wives were left behind and their children, they would transfer those assets to someone to hold it legally so that the children and the wives were protected and that no one could take those assets from them anymore. And that's something that has passed on from generations. It's a beautiful concept and one that's used to achieve a lot of non-tax benefits as well as tax benefits. One of them very critically being asset protection. And so once you're getting into that phase of, oh, I'm buying, you know, new acquisitions in other jurisdictions, these are concepts that will come to mind. You know, should I put that trust in place to hold the asset? You know, what's the right structure? Should it be a corporate vehicle based out of the UK, or should I hold it somewhere else in Mauritius? Those kind of structures may be holding companies. We've talked about trust already. And then wills also have a very important place here. But, you know, one also has to consider some of the downsides from a Nigerian perspective as well. The beauty of trust versus wills is it takes you out completely from the probate process, and you don't have to consider those huge probate levies or administrative process that lengthen the period during which those assets are transferred to the next generation. Now, if you have a will, on the other hand, those are things to consider. But that doesn't make the wills less important than the trust. There are advantages of having wills, which you also need to look at. And I think Simon has alluded to some of those just coming from the UK perspective, where you may need to have a UK will to protect you from the inheritance taxes, and also insurance policies. I don't know if Simon had mentioned it, but also something to take note of as well in the UK. Maybe not so much of a concept in Nigeria to save you from taxes, but definitely something to consider in the UK. So yeah, Ladi.
Sorry, Ladi. Of course, I've got to say something in response to what as we said. So in no particular order, trusts, which I spend my life drafting or working with some of my friends who are participating today in places like Jersey and Mauritius. A trust can be a great thing for things like asset protection, succession planning. But what is important, and it demonstrates the importance of seeking advice in both jurisdictions, is that if you use the wrong trust structure, it can create immediate inheritance tax liabilities on the acquisition of the property. it can create charges every 10 years, and there could still be a charge on the death of the person that established the trust. So I love trusts, but it's got to be right in the circumstances. Secondly, on wills, and I agree with Esri about the ability of a trust to take the asset outside the probate process. It doesn't take it outside the inheritance tax process. So when Esri talks about the probate levy, which is a form of inheritance tax, you can have a trust, but it's still subject to inheritance tax in certain circumstances. When we look at wills, something that's very important to remember is if you don't have a will and you own a property in the UK, then the government has put in place rules which will determine how your property passes. And it won't necessarily be to your spouse. It could be to children. It could be, and I'll give you an example. I put in place, I did a structuring for a client based out in Abu Dhabi, and he gifted his property through to his 4 children for inheritance tax planning purposes. And then very sadly, one of his sons died at the age of 18. He wasn't married. He didn't have children. So lo and behold, the property passed back up to the parents. So but the only asset my client had received from his unfriendly divorce was this particular property. So half of the deceased son's share then passed back to my client's his divorced wife. So that shows the importance of thinking about things. If all anyone does when they buy property is put in place a decent will, whether it's with me or anyone else, this seminar will have been worthwhile. And the last thing I'll mention, as you're all getting to know I talk too much, is insurance policies, which Esri mentioned, and I'm sure Ladi can help with. If you have an inheritance tax liability, we can insure that liability for whatever period that you think appropriate. We can then place that policy into trust and help mitigate inheritance tax that way. And I truly will be quiet now, Ladi.
Well, thank you very much, Simon. Thank you very much to all the speakers. We've come to an end of today's webinar. And as you can imagine, we've had professionals talk about such an important broad topic on property tax, estate planning for African global citizens. And as you can imagine, this time is not enough. But literally, your family office is the office that can put all these professionals together and pull the strings and make them work for African families. So I really want to thank you again for joining today's webinar. I have our contacts on the screen here as well. If there's any questions that you have moving forward, please reach out to us and we'll be happy to help. Again, thank you very much.